Hello, everybody, and welcome to episode number 106 of Confessions of a Market Maker. I'm your co-host, Ray, aka All Day Ray, aka Wally Balls, and I'm joined here by my renowned co-host, former market maker, 20 years and current day retail trader, the man who's brought to you some of Vancouver's most infamous deals, the prodigal son of House Street, and the man who's got more stories than Forrest Gump. JJ, how's it going?
What's up, brother? How are you?
I'm doing great, man. We got a special episode today, man. We got two guests. And our first guest is a trader and quantitative developer on the Intercontinental Exchange, as well as a quantitative trading researcher at web services group Powerweave. Getting his start trading markets in 1980, he's been a member of both New York and Chicago exchanges for over 30 years. He's had a front row seat throughout the market's transition from floor to electronic trading. I'm talking about Chris Caddy. Chris, how's it going?
Hi, everybody. Thanks for watching. For people who are checking us out at a later date, today is April 18th, 2023.
April 18th is the date, and our second guest is the director at Profile Trading. He's an active researcher and refined the methodology into a powerful trading framework and system. He's been involved in the markets throughout his professional career and has acted as an institutional broker, some of the world's largest investment banks and trading houses in the world. He's collaborated with other professionals to write several trading books, with his most recent book, Steidlmayer on Markets, Trading with Market Profile, second edition. It's considered to be a classic guide to the revolutionary trading methodology called Market Profile. Of course, I'm talking about Stephen B. Hawkins. Stephen, thanks for joining us.
Thanks for having me. I appreciate it. Look forward to spending an hour with you guys.
Now it should be a lot of fun. All right. So now that I got past the long-winded intros, appreciate you gentlemen joining us. I always like hearing people start into the markets when they first gained interest, how they got their first job. So I guess, Chris, we can start with you first. Can you just give us a little background how you got involved in markets?
Yeah, it was 1980, summer of 1980. They just created stock index futures. I went to work on the exchange for my stepbrother, Kevin McAuliffe, and we had a disagreement, and I volunteered my services to Walter Frank. And after 2 weeks, his father was chairman of the New York Stock Exchange. After 2 weeks, I said, "Are you aware I'm not getting paid?" He said, "No, how much do you need?" In those days, they used to overstaff to accommodate for the bulges in business on the exchanges. And of course, this is many years before computers, and everything was done, as they would say, everything was done. Action was in the wrist and on paper. And so he was like, "Yeah, I knew the clerks got $250 a week." He said, I said $250 a week. He said, "Done." And then 9 months later, he made me a member. And it was off from there. It wasn't until 1991 that I actually got to meet Pete and Steve.
Nice. Now, Chris, was the market something you always know you wanted to be involved? Do you remember? Did you always have a love for it? Do you just remember like that first moment?
Well, yes. I mean, obviously, when you first walk onto now you can no longer do this, but when you would first walk onto the exchange floor, it was a combination of NASA meets Vegas. Right? It was, at the time, it was the techiest. It was also filled with the most famous storied gamblers, risk takers, real shooters, sure, and people who, as all of us who were there know, right? It was like the Marlboro Men. It was, Americans are so identified with the cowboy image, and this was a place where all the cowboys, modern day cowboys, could make it or break it.
Interesting. All right, Steve.
Yeah, I guess mine was a little bit more traditional. I went to university. I've got a degree in economics and finance. I had an interest in the markets. I really can't say that I expected to spend my whole career in the markets. Just had an interest in them. I was first job out of university. I was in the mid 80s. I got a job at a brokerage house, and it was in the South Loop. And I happened to go out for lunch with some guys and ran into an old high school friend, and he actually had partnered up with Peter Steidlmayer the previous year, and they were launching a company, and I was always a decent athlete in high school, and a lot of people believe, gamblers and athletes can become good traders. So they asked me if I wanted to be involved in their company. So I just kind of from the ground bottom up, learned the methodology. Then I started working with individuals, more retail guys, understanding it. Back then they had something called Market Logic School, which was a school, that would run probably once a month. They would have a week-long session as far as educating people on profile. And I would help the people who wanted to get additional help, and started on the with individuals and professionals, and then got involved with some bank traders and training them, and involved in money management, and that's kind of my whole progression.
Cool, Steve. Why do they say that athletes and gamblers transition well or make for good traders?
I think primarily the discipline that trading requires. Obviously the most important aspect of trading, I would say, is being disciplined. Getting in, important to getting in, but more importantly, getting out. I mean, if you can be disciplined in managing the risk, I think there's lots of opportunity, and you should be able to make it in this game. But if you don't have that quality, then it's going to be much more difficult.
For
Jay,
sure.
can I add something, Jay?
Mm-hmm.
When I asked why they made me at 20 into a member of the exchange, Walter Frank said, when he told me this story, he said, when you're ski racing, right? I came as a ski racer. When you crash, what do? I say, I dust myself off and I change my technique. And he says, that's why we hired you, because he says, we look at all these resumes from people who've checkboxed their way through life, right? Choate, Harvard, MIT, wherever, London School of Graduate, Chicago School of Economics, et cetera. He says those people have been told what they do is the way, what you have learned is the way things work. And then Walter went on to say that essentially markets don't function that way. What you need is what they called at the time transitional coping skills, the ability to deal with change, right? So obviously discipline is required or you lose all your money. And so, but the addition of people with a non-traditional background generally have better coping skills with transitions than those people who have checkboxed their way through life. Because under a stressful situation, if you've gone to Harvard or wherever, no rip on Harvard, but if you've gone to a pedigree school and come through a pedigree background, you have so much invested in that you think that what you've learned is right. But by definition, what you've learned has already happened, and the markets are always evolving.
Fascinating.
So
Fascinating.
true.
Yeah.
Wow.
So I'm interested in, I think a good next starting point would just be how you guys met. When was the first time you guys crossed paths, and whatever one of you guys want to take a stab at it?
1991, NYMEX, which is literally 100 feet off my right shoulder. Pete and Steve came to teach a class on their data segmenting software, and called CapFlow. Was it called CapFlow then, Steve?
Yeah. Mm-hmm.
And it was required. It was 5 days of no one had shown up on the exchange and was like, we're going to teach a class. 5 days, you got to be there for 5 hours after the bell.
Wow.
I think that's when Daniel Rappaport took the bull by the horns and really wanted to find a way to make the floor traders more viable. I think markets were changing, and they saw the benefit of education, which is of course important in trading. And so they spent a good chunk of money to bring us out there and educate the traders, and as far as methodology goes, and then also got them exposed to the software, which they had some licenses on the floor, and we got a big following there, and I think it served the trading community well. I mean, if nothing else, it kind of got them like Chris mentioned. I mean, I think looking at things and being a little bit flexible in how they look at things, bringing new ways of viewing the markets, and I think that's always important. You don't want to be too active in changing your perspective or what you're trying to do, but you do want to be open to maybe things that can help you. And I think that the market profile is a wonderful tool as far as organizing and displaying data.
And so a quick footnote, Danny Rappaport, who Steve just mentioned, was chairman of the NYMEX at the time.
Mm-hmm.
And before the exchanges were a for-profit entity, the members would elect the chairman. And so Danny was, of course, a very popular member and then chairman. And so they didn't have to necessarily answer to shareholders in regards to the path that the membership would pursue. And in this case, it was a 5 day. Was it 5 days or was it
Yeah,
2 weeks? It was five
it's 5
days.
days. Yeah,
5 days, 5 hours. Like you go to work and then you have to sit down in a classroom, and there must have been 300 people in that room.
yeah, yeah. It was a big gathering. At lunch, I think something when you arrived. I think early on they maybe had sandwiches there, and then we got into the nuts and bolts of it, and sat like you said 4 or 5 hours, and by 6, 7 o'clock, I think people were getting glassy eyed and ready to go home, but
Right.
they
Right.
they stuck with it.
Yeah. And so for all of us who had been just in the ring, uh, it was a massive transition. Pete was like, yo, he was literally like, yo, people, the electronic trading is coming. You better, because you're not going to be able to stay up 24 hours and watch this. So you're going to need to segment data while you sleep so that when you wake up, you can be in step with the market the way it would have happened if you were watching it in the ring.
Interesting. And this was not early 90s.
Yeah, 91.
Okay.
Mm-hmm.
Interesting. So, because Steve, I think you said because you guys came to teach the course because the markets were changing. Was that kind of what you were referencing, like the transition to maybe more from the floor to electronic trading?
Yeah. We like to say, way back when early on, I think all the liquidity was on the floor. Chris kind of tested it as far as the deep pockets and the ability for people to take on positions and everything like that. The locals could absorb pretty much everything, but as more funds got involved in banks, that's when the liquidity moved off the floor. And I think the position that the local could take and everything else, they couldn't absorb the order flow, so it's really necessitated the locals, the specialists, whatever was trying to take the other side of the trade, a way to organize data, and this was the way for them to do that and kind of put them in a position to manage the trade and manage the risk, which is of course important. Back then people could average, and there's if you had deep enough pockets, you could do anything, and it's going to come out in your favor. But with all the liquidity off the floor, that no longer was the case.
I mean, the example of that would be, for example, the broker would approach the ring and say, what's here? And typically in the old days, we'd say 5-6, 5 bid at 6. And the guy would say 6 bid for 10 million. And you just be like, you'd just be like, so in the funny way is right is that we eventually learned on the floor that the guy would come in and go, what's here? We'd say, you tell us.
Wow, that's quite a change. I mean, I worked with market makers for decades. I got in right when the floors were closing in Vancouver. So the guys who taught me were ex-floor traders, and so I learned about things like inventory and how inventory moves, and how when the order flow hits, the inventory moves and that sort of thing. And it took a while. I mean, even with us, we were all equities based. I mean, the software we had level 2 software that we had to refresh by hitting enter all the time. It was Dow Jones Telerate,
Mm-hmm.
Right. I remember those, right? I remember
and you had to
right?
sit there and hit enter all the time to refresh your level 2. And because we were making markets in 20 or 30 different companies, were moving US market makers around, and then trying to like capture the buying. That's basically all we're doing, because our clients were like, what did it trade? 15 million shares. How much did I sell? 6. Okay, see it, kid. Call you tomorrow. And that was it. They didn't care about price because they had their paper at a tenth of a penny, and were selling it into $3 volume, $10 volume, whatever it was, right? So we were liquidators, and when I started trading, I'm just so excited to have you guys here, because if not for Market Profile, after my heart attack, I would have had to go back and start doing deals. I would have never made it in retail trading. It gave me the understanding of how exactly how to see a market properly. So I couldn't even execute without knowing where to execute, what to do. I was, people were trying to teach me candle patterns, and bulls holding flags and raccoons holding t-shirts and all this stuff. And I was like, okay, where's the bid? Because my whole life I've been taught, just go find the bid and work off of it, right? If you're a short seller, find the bid, that's where you're covering. If you're going long, find the bid and go long in front of it, and front run the bid. So when I saw profile and you could see like how accurate it was tick by tick, it just blew me away. In fact, it blew me away so much that I'd come up with levels and things like that, and it would trade right there to the tick, and I'd be so blown away I couldn't even take the trade. I was just flabbergasted. It took me, it was just, and the thing was, I was trying to tell people, you got to look at this, you got to look at this, but they didn't want to put in the time to learn it. And that's the thing. It's, it kind of hurts your head when you first look at it. If you've never seen these charts before, you have to sort of kind of open your mind and be open to learning new things without arguing constantly, which I find a lot of traders do. They're like, but I'm like, just give it a second and watch. And
time out. What would you suggest for someone who's watching for the first time? And here you have Steve Hawkins. What would you suggest that person, how would they approach market profile from the beginning? Hello?
Steve, or are you asking
Yeah.
Steve?
No, JJ, I'm asking you.
JJ, asking JJ, right?
Yeah. Think about our audience, right? They're here. They're like, okay, so everybody wants me to learn this profile.
Yeah.
Like, what would be the step one? What do you think you would say?
What I usually do is, it's hard to explain it for me without showing them. So what I always do is I throw up a Zoom and I'll watch a market trade and I'll show them the steps of finding where the buying is and where the selling is. Because as a retail trader, all they really need to do is know where the buying and the selling is. And if you know where the stops are in a half-hour profile chart, generally, if it can't run the lower stops, the market will turn and look for supply higher, right? And once they see just something like that, they start to click in a little bit. I find that there's so much about profile, but to quickly show someone, I usually take them, put them on a Zoom and show them, and I'll be able to say, like, all I trade is ES. I'm very loyal to one market, so I just trade the ES, so I know it. And I've been looking at it for 6 years for 18 hours a day. So when I tell people, okay, watch this level, it's going to come down and pause, and then turn, and then probably go back up. And it does that, like say at the bottom of a half-hour TPO, they're just blown away by it. They're like, how did you know that was going to happen?
But the idea is to make people self-sufficient, right?
Yeah, that takes time.
Of course, right.
That unfortunately takes time.
Takes time, right? And so, you made an interesting comment about how you let people watch the profile fill itself in.
Yeah.
And maybe Stephen can touch on the way the market rotates around, and maybe that will offer people who are just watching profile for the first time, if there's some value to watching the way the profile fills itself in over say a 2 or 3 hour period. Stephen, is there a value to that?
Yeah, of course. I mean, we're, in the book that I wrote, we talk about the auction process, right? I mean, on the floor, off the floor. I mean, on the floor, obviously, you're right there in the meat of it. You understand the dynamic of the bids and the offers coming into the floor. I think you see the same thing in the screen, like we talk about the 4-step auction process, series of prices in the direction, and then the stopping, and then the development, and then the, essentially try to revert some type of mean reversion. Is it going to succeed in doing that? Creating some type of symmetrical, the Gaussian distribution, talking about the Gaussian distribution and asymmetrical or symmetrical type of a distribution. Is it going to be something that's going to have a tail, or is it going to be more normalized? I mean, that's what understanding profile is all about, is time visualization, I would say. And, the screen time you get, you had guys mentioned, Peter Steidlmayer, he's one to develop the profile, and Jim Dalton, he was an early student, and he's kind of gone off on his own and built his own business out of it. And he's kind of stayed in what I would call legacy profile land, screen time, observing, and kind of building your inventory of observations that you can utilize to trade with. And and we're more or less gone down the path of trying to automate things and, time variable profiles and utilizing, additional input, i.e., what is the background relative to the foreground? What is the volume you're able to see at time versus volume at price, which is what a lot of people look at just with the liquidity data bank. So I think that, it is very, very important to be able to visualize what's going on in the market. And, we're proponents also of, JJ mentioned becoming a master of ES, we're more proponents of trading opportunities. I track, 40 or 50 markets, trying to find the cleanest opportunity. So I'm Chris is a master of the stock indexes. I'm a jack of all trades, I would call myself. I look at everything from fixed income to foreign exchange, to metals, to energies, equities, and just really trying to find some type of a clean setup. I think that JJ or anyone who's trading, they're going to have some setup they like, and my contention has always been that if I'm looking at lots of different things, I'll find something clean. If I can look at 5 markets or 10 markets, 20 markets, I'll find a clean, 2 or 3 clean trades every day versus forcing myself to trade just one market. It's on the floor, right? The same thing when you're on the floor in the pit, you're forced to trade just that market. And sometimes there were great days to trade and sometimes not so great. But if you could float around on the floor to go to the market or the pit that had the best opportunity, that's a more advantageous position to be in. And that's why we're proponents of trying to trade lots of different markets.
Pete used this, just to summarize for someone who's watching and unfamiliar with profile, one of Pete Steidlmayer's sayings would be, if you're a fastball hitter, instead of looking to hit a curveball, just crush fastballs.
Right.
And so that would be the takeaway for the person who's just learning profile, is become familiar with it, find a setup that works, and then scan through different markets that that is a particular. And so if we drill down to the understanding of, we're looking for setups that work, then, and there is a particular setup that works, then there must be a reason, a theoretical auction market theory, right? Is that something that we could call this, right? If there must be a reason for why that setup works. They don't just, there's no magical black box behind it, right?
Exactly. There's a business that's creating the chart.
Right.
It's, like my favorite setup is the look below and fail.
That's Steven's favorite. That's one of Steven's favorites.
I love that trade because, inventory gets too long, it sells off, and then everybody thinks it's going to sell off even more, but it's just inventory. It's inside supply. There's no other time frame sellers because it hits your very specific references to the tick and stops, or it looks below just a little bit, cleans out that level, pops back up, and then you can take that counter inventory trade, and it's just beautiful. And once you do it over and over and over again, when it's going to work, when it's not, how to kind of read the price action around it. And I just love that trade.
Pete would describe that as the market closing off a direction, which was very strange, right? Which was very strange to hear if you'd never really experienced it the way you're experiencing it now. But do you hear the people out there who are listening for the first time would recognize the that recognition in your voice. Steve?
Yeah, I think the best attribute or quality of a profile is it allows you to kind of verbalize what's happening in the marketplace. A lot of people who look at all the technical indicators, Chris uses CQG, and there's 101 different studies on there.
Oh, jeez.
And they're all external to the market, as we call them. And as Pete always says, markets don't create a moving averages or stochastics or relative strength. What doesn't market do? It creates acceptance of price, rejection of price. And if you can kind of break the market down into that context and really understand what's going on within the auction, that kind of really puts you in an advantageous position. So I think just to your point of viewing the price action, there's nothing that can replace that. We've always said that a person can trade better than a computer, but a computer has more capacity than a person. So pick your poison, I guess, right? If you could trade 24 hours a day, sit in front of a screen, you're unique. Most people really only have a certain capacity to sit behind a screen, right? And I would say it's less than what they might think, as far as staying focused and being able to do the right thing. I mean, that's what I always, for me, the most important thing about trading is doing the right thing, whether it being putting the trade on or taking it off. If you can always say you're going to do the right thing, you can put a trade on and know you manage it properly, or you'll get out of it properly. And if you can do that, you're in the driver's seat, I would say.
Definitely. I myself, how I try and explain profile is, I'll pull up a time in sales and I'll say, okay, you guys, here's the time in sales. These are transactions, right? This is just a record of all the transactions that are happening. Profile is a sort of a two-dimensional record of that, where you can actually put it together and make some sense out of it, organize the data in a way that you can make sense. Like if you see in a market, 3 or 4 poor lows every day stacking up on top of each other, supply is running out and the move is the upside because the bid keeps moving higher, forcing people to take the offer, right? And it's just amazing. I started playing with balance zones, and I noticed that you have something called the PG2 mark indicator.
Yeah,
And
page 2, yeah.
Page 2 mark indicator. Like,
Mhm.
because the one thing that Jim said once was, you take this balance zone and then you double it to get the target. And I was, kind of lazy coming from the institutional side. So I grabbed onto that and held onto it like a lifesaver. And I
Okay.
started developing these balance zones for equities and Bitcoin and ES. And I noticed that after a while, like once you start looking at find a balance zone, no matter what time frame you're looking at, even on a candle chart, it works. When you double the balance to the upside or the downside,
Mhm.
the accuracy of the target is just it just blows you away. I mean, I have balance zones that I came up with in April 2020 that still
Mhm.
give decent results.
Can you break it down so someone who's watching and learning profile for the first time understand what the procedure that you quickly, can
Sure.
you explain that in 30 seconds, exactly how you do that?
Sure. What I do is I look for a bracketed, what you guys call, a back and forth bracketed market, in a range, right? And then I'll look at the top and the bottom of that range. And if it looks above the top of it and comes back to the bottom, looks underneath the bottom and comes back up to the top, you've got balance. Then you take that and double it to the upside and double it to the downside. And I swear to God, when I do this, people, it's like I'm doing a magic trick on the screen. And the market will go right to the thing to the tick. And it's not because I'm at all intelligent or anything, It's like I'm like, then I get them to do it and they start doing it. And I'm like, okay, great. Now we got to figure out how to trade this. That's another thing. But once you see that and the power of that simple yet such an elegant thing, um,
Segmenting, perhaps we could call that segmenting data. You've discovered a very simple, non-complex method of segmenting data predicated on the mean reversion aspect of the trading day.
Yeah, we had those way back then, when Pete first came up with it, and I talked about it in the book as far as talking about normal variation, some type of expansion from balanced to imbalance. And I think that those range parameters that we're talking about, that was something that, is transcends markets, and you can expand that, from different time frames. I look at weekly auctions. We're talking about an auction, right? You can talk about quarterly auctions, way back when in fixed income, they used to have auctions every quarter. Then with the energy space, I mean, you have the API numbers that come out weekly. So I mean, anything that has some type of a regular reoccurring event, essentially what's happening. You have the grain reports. I mean, you're having some type of supply demand equation that's being analyzed and getting some type of a hard fact out there that people can kind of, the fundamental guys can integrate into their models and try to trade, and that kind of allows for those parameters to kind of be met, I think, and they're definitely good tools to try to integrate into what you're looking at. It really gives you some good levels to kind of lean against.
That's genius if you think about it, that they're, instead of using the open and the close as your parameters from segmenting data, just use those reoccurring fundamental start and stop points.
Yeah, they're just natural starting and stopping points.
Yeah, right. Instead of using the clock, right? The clock only exists from a perspective of I'll meet you for lunch at 1 o'clock, right? In a 24-hour marketplace, what purpose? The clock doesn't mean anything.
Exactly.
Mm,
Exactly.
interesting.
It's beautiful. It's yeah, the amount of information, uh, I was lucky because for 5 years I was looking after my mom in a place called Saskatchewan, where it's like -60 for like 8, 10 months out of the year. So really, you're stuck inside. It makes Chicago seem like the Bahamas.
Mhm.
And so I was, I had 18 hours a day of screen time. Then even in the summer, there was not much to do. So, I'd sit there and just watch markets, the ES trade over and over and over again and see and see the power of this. And then we started trying to teach people, well, retail traders, who are struggling to find consistency, and you show them the lessons of market structure, and they didn't even know that such a thing as market structure even exists. So once you open their eyes to that, it's just, it's like taking a blindfold off. It's quite an amazing process.
Stephen, when you teach people, it's been pretty much a tough love sort of environment. Pete's method of teaching was he would teach a class and then never go back. In other words, you had to have been at that class, right?
Oh,
Yeah.
wow.
I mean, for us, I would say, first of all, I would say 80% of the people that we get in touch with, they probably have some experience, in a lot of cases, lots of experience with the profile, and so they're somewhat knowledgeable in the concept. And I would say what we offer, what we have is a stepped up version of market profile. Something that's much more cutting edge. Something that's much more dynamic in what it can provide people to work with and trade with. I mean, of course, you have to have a starting point, but yeah, Pete is. Yeah, we started developing software in 1991. Then the first iteration, 16-bit application. We worked with that for 7, 8 years. We started a new 32-bit application, in 1998, and we're still developing it and are enhancing it. And I think we're out to build, 2050 builds. So we have.
No, sorry, mine says 2164.
2164. Okay, 2100 builds. So
Versions of it.
always trying to make it better. That's when we first started, we thought we'd start developing something and get it complete within a year. But for seeing how it's serve our own purpose of trading, it's important to keep it what we feel is the best, as far as the best software out there. So we'll continue to add it and make it, improve it. And I think that as Chris said, I mean, there's people have been using our software for 20 plus years, and with all these different iterations of the programs and builds, some people will kind of step off and use certain functionality. Some people want to keep forging forward, but it's just personal preference. But as Chris said, Pete's always trying to, and in trading, I mean, that's one thing you're all going to find in trading. If you stick with it, you're going to have to evolve yourself, and it's not going to be what worked 5 or 10, 15 years ago won't work as well as does today. You'll have to refine yourself and change your approach a bit.
I mean, a super interesting conversation is what's the volume at the high or lows, and how we had gone from, it used to be we're always looking for climactic bottoms, like you were saying, like they run the stops to the downside and then they reverse. And because now with electronic trading, we have a footprint of both volume and price. At every transaction leaves a footprint, whereas in the ring we didn't necessarily know the size because it was so chaotic. And the most recent thinking appears to be that at the highs and lows is a lack of volume.
Yeah, I mean, it's kind of interesting. I mean, I think that back in the day, as Chris can attest to, locals would always try to put in new highs or new lows to check for stops, right? And that would be one of the exercises they all would take to just kind of see what was up there. And would that initiate covering, or would that be something that someone would be willing to fade? And so I think that was the floor mentality, way back when. I think just kind of checking for that. And I think electronically, because the market's much more deep, right, Chris? You can see that in the book. It's hard to really approach the market from that standpoint. Next thing you know, you're long at the top or short at the bottom, and nothing to help you out there. So I think, as Chris mentioned, I think the whole there are times, actually one of my favorite setups, honestly, is looking for that exhaustive volume at a market extreme, right, Chris? The red profile, we call it. I mean, there's people who trade just this exhaustive setup, myself included, whenever you see that as some type of market extreme. But you do see, we have other things that look for concentration of volume. So I think concentration of volume, where the market, doesn't follow through. I mean, Peter used to always say all the king's horses and all the king's men. So everyone and the brothers bought the top or sold the low, there's going to be no one left to piggyback that idea, right? So it's going to have to mean revert. So looking for volume to be exhaustive at an extreme is also something to, at least for me, it's something that I've continued to focus on.
Hey, Steve, would that be relevant to like, hey, all the good news is out and you sell them here?
Yeah, yeah, for
Sort
sure.
of, that old cliche where we would be like, or all the bad news is out, we can buy. But like my friends would say, you buy heating oil on the hottest day of the year.
Yeah, right. No, I think, there's a guy that we know that Stafford over at the SIBO, John Stafford, and his favorite saying is, or what thing that I always remember about him is, what's more important than what happens is what doesn't. So you get a big bullish number coming out, and the market doesn't rally, or you get a big bearish number, the market doesn't break, and that kind of really sets the tone. Why is that? I mean, could be everyone set already on that side of the market, and there's no one left to buy that bullish report or sell that bearish report. So those are some little nuances that I think, as far as really trying to capture what's going on in the market. And I think if you can, over time, those are things you pick up upon. It's not something that is going to be ingrained in your head, tomorrow, but that's through experience and observations, you'll be able to pick on some things like that.
Hey, Ray, you were a poker player, Ray.
Yep.
You use tells, right? Is this equivalent to a tell?
Yeah. I mean, there's physical tells, and then what I think is even more important, betting tells. The patterns of people's betting. So yeah, I think it's a fair equivalent.
Steven, do you ever play poker?
No, I go to casinos, and I like I tell everyone that I talk to, I'd rather make an educated decision versus just flip a coin if I'm going to be taking on risk or speculating. So I've always not been too engaged in that field, actually.
Do you ever buy lotto tickets?
Yeah. I mean, I just always like things like, I like to go fishing because you never know what you might catch, or you buy a lottery ticket, you might win that $1 billion or $100 million payout. So yeah, that's one attractive thing about things like that. And you never know what's out there that you could potentially walk away with. So that's always kind of fun to do that kind of stuff.
And you guys, you'll never believe this, but sometimes Steven puts on a trade and then turns off the screen.
Right. That's for me.
Wow.
I always have an idea, good idea, and what I want to do. Trading structure and everything that I look at. I mean, I look at like we say, price plus times equals value. If that's what you're looking at, that's price acceptance or rejection. We have things we look at as far as what is the background. We're looking at volume things. So I mean, there's anyone who trades, I think that they have a setup that they like to trade, and for me, I like to look for certain setups, and I like to put the trade on, and I know where I'm right or wrong, always, or where I'm wrong, I should say. So, instead of creating the anxiety of putting a trade on and watching it move for you and against you, and over managing the position, I've always opted to just turn it off and move my focus to another market or doing something else. I think that's, for me, it served me better.
So the idea is that as the trade unfolds, we don't know if it's going for us. We have to manage it once we're in it from a perspective of maybe there's more to this.
Yeah.
No.
I think like on the floor, Chris can attest to this. I mean, we would see people on the floor, when markets moving around a lot, lots of opportunity, but then when markets would get kind of quiet, you're just trying to make your nut right for the day. And so you're increasing your volume, and you're going to put yourself in positions, we'll say you're trading corn, you're trading a 50 lot in corn, you want to make a half cent, so you're going to be, looking to make, $1,000 or so. And that 10-cent move, you'll never capture that 10-cent move, right? Whereas you're looking to risk a half cent, but then you're going to get blindsided because something's going to happen once one of your trades where you're going to take a 5-cent loss. So I think you always want to have expectations of the market, but you really want to, like we say, let the market breathe. Pete would always say that you want to Pay the
What he's
grocery bills with the long short-term trading and put the money in the bank with the longer-term trading.
he used to say keep unchanged on your side as long as you could. He'd say like if you
Yeah.
can get the right trade location at the initiation phase, it would sometimes buy you time because he would say trade location is like in real estate location.
Exactly. Yeah.
Yeah. Mm-hmm. Mm-hmm. Yeah, no,
So
absolutely. No, I
and
think
so for a long time he was always like, if we can buy some time without the market moving against us, it'll give us a chance for the market to go our way.
right. Mm-hmm. I think that's
Yeah.
always real important. I think you'd know when you're wrong. That's if you can do that in trading, you can have some type of backstop. You're in a favorable position. We never know what's in front of us as far as our potential in the trade. But we know when we're wrong. And I think you know what's the saying go? Markets can stay irrational more than you can stay liquid or whatever it is. And so
Mhm.
or the cart runs fast at the bottom of the hill. We would always like to throw that one out there, and so that kind of goes in line with what potential there is in the market. It probably exceeds what your expectations are.
That's a great thing. Just recapping that is that the car moves fastest at the bottom of the hill means that generally if we're right location, then the trade starts to go our way, then it's going to be slow, eventually moving quickly.
Mm-hmm.
And that the corresponding aspect is if we're wrong, we need to shorten the duration between recognizing we're wrong and acting to get out.
Mm.
Mm-hmm.
Very true. Very true.
That's a challenge. I'm sorry, go ahead.
It is. I was going to ask you, gentlemen, about something that we found really, really instrumental in our trading is the concept of single prints between two distributions. When a market rips and leaves single prints where it takes the stop of that swing high or the previous day high, and shorts are trapped there, and then you'll see that the single prints will build out, and then when the price comes back down, there's a bid, right? It comes right into that bid because that's where the shorts are trapped in their bid to cover. That aspect has helped us save so many people from getting short or not covering a short because I'm like, hey, there's single prints, and if those things don't fill, this thing's going to keep going higher because we're out of supply, right? Once you run out of supply, demand, because listen, I used to manipulate stocks for a living, and I know once you got the float tied up, there was one stock I could move $10-15 a share by spending $800, so they're so thin when there's no supply. The concept of single prints is it's astounding how accurate it is. It's one of the most beautiful things I've ever seen. And 90% of people don't even know what they are, you know?
Stephen calls that minus development.
Yeah, that's a big imbalance in the market, as you attested to. And why are there single prints? And on the rally, as you made reference to, I mean, because there was no opposite participation, right? There was,
Yeah,
the buying overwhelmed the selling, and once they were able to kind of match up, then you're going to get single and double and triple prints. But,
yeah,
for me,
exactly. Yeah.
I always look to trade halfway back into that. As far as initiating a trade, you got the imbalance on your side, and the magnitude of the setback. Can it trade back just a couple ticks into it? Can it trade half back, and it trade 3/4 of the way back? That kind of gives you a underlying perspective as to how powerful they are.
That's for everybody listening, single prints are like a gap, but it happens during the day, and then the markets tend to fill those, generally speaking. But Stephen's come up with a really great distinction, and within that framework is that it's possible that they don't get all of the minus development retraced, and that offers a sort of a temperature gauge in regards to the appetite or need for particular positions to be closed, as people are willing to cover or to exit before the entire sort of inefficiency is traded out.
Yeah, and it gives you kind of a real clear roadmap as to where you can do something at and where you're wrong. I mean, what more could you ask for when you're trying to put on a trade?
Right.
Exactly.
So
Right.
Exactly.
kind of
Right.
something that when it works and it has really good potential, and then it's pretty clear when you're wrong. Because you're trading for imbalance, and the market going to balance negates that idea. So you have to, cut the cord and move on.
All right, just got to take a quick second to shout out our good friends of the podcast, Apex Trader and Top Step Funding. Any listener of this podcast that has the skills to pass an evaluation can become a prop trader fully funded. by either Apex Trader or Top Step Funding. Our own Micro E Futures trading community has many members who are now fully funded. No need to trade with your own money. Keep 90% of the profits. To learn more, you can visit our website at microefutures.com. Steve, a while back you mentioned, which I really liked, how you like to look for clean setups, so you look through various markets. I'm curious, do you have maybe just a few strategies that you apply through all the markets, or maybe do you segment certain strategies for specific markets?
No, I mean, for us, I mean, we really like to kind of come up with ideas or strategies that they're not market specific. I really like to come up with things that are more generic, more general, that you can overlay all markets. I mean, that's more of a favorable strategy, I would say, versus something that's really specific to one market. So I like to look for things that can overlay anything and everything. Things that I like to look for. One would be exhaustive volume at an extreme. So you see the market and trading in some type of a range. What's market, especially when it's on the opposite side. So, for instance, markets trading in a range. We'll say crude's trading in an $80 to $100 range, and I see heavy volume buying at the top at $100, or heavy volume selling at the bottom $80, and then the market start to move away from there. I would be looking for the market to potentially, reverse from those levels. That's always a favorite trade of mine, just looking for exhaustion. At a market extreme, with people getting offsides, people selling the lower, buying the top. That's, because that's when the market's going to move the quickest, vertically, as well as the fastest. So, people offside, if you're trading in a, $100 to an $80 range, you buy 100 or sell 80. You can see that, and then if it starts going against you, you can say, I'm selling the market on an $80 to $20 break or buying on a $20 rally. So, I think that's going to induce those people potentially to start covering their shorts or longs, and then people who want to fade and say, I want to be trying to trade the top of the development, sell it, or buy the bottom. They can kind of then lean into the short covering at the bottom or long liquidation at the top, and try to add fuel to the market continuing to try to mean revert. So that's one of the trades I always like to look for. Single prints, as JJ mentioned, that's always something that's really, really clean as far as a trade setups go. Similarly, what we've always been big believers in is a big vertical move one way and then reversal of that vertical move. That really kind of sets the tone for some longer duration. So, some type of a price spike up one direction, we'll say rallying, and then the market reversing all of that. That's going to set the tone for a top in the market. So, or similarly at the bottom. So those are three real objective, clear setups that I really like to trade.
You can make a career out of those three setups.
Right.
Definitely. Quick question. What do you gentlemen think about these large, massive ranges in the equity indexes, like the ES these days? I mean, really, these things are, when I started trading ES, you had tight ranges, you saw those B-shaped profiles, things like that. Now you just get these massive, massive ranges. I have my own theories, but I'd love to hear what you gentlemen have to say about that.
Can you refine that? Can you ask a more specific question?
Well, the daily trading range in the E-mini, for example, right? The range, I noticed that over the last couple of years, the daily ranges have gotten larger and larger and larger. And I, remember learning about the B-shaped profile and the P-shaped profile and that sort of thing. And, that B-shaped profile, you see those building up, you see tight consolidation, and, you see them building a cost basis and then a move higher, for example. Now you just see these huge back and forth profiles, and with very, very large ranges. So I'm just wondering if, what your gentlemen's views on the ranges and that, how a little bit of size comes into the book and it moves the price drastically these days.
I'll go first, Steve. I know we could talk for days for people who are listening. One is, of course, the economic nature of just-in-time inventory. Another is the information dissemination is so rapid that it takes time to find opposite In other words, if the world is long,
Yes, yes, yes.
and because everybody has the information and say they're long and they're wrong on some headline, no one's going to be in a hurry to take the problem off your hands.
Mhm.
So the markets have to go further before the buyers, or price-wise, they have to go further in obviously short amounts of time to find people who are willing to step up and assume the risk of your mistake. On top of that, there's no incentive to be. Everybody knows that markets now express themselves vertically rather than horizontally. So there's no incentive to sit there top of book. And the risk element in regards to being a market maker means at any time there's some sort of dislocating price action without any news event known, that means that the market makers just pull their bids anyway because they
Yeah.
don't know what's happening.
Bit off, yeah.
As well as I'm sure there are many algos that proceed to be, or kind of taker algos will just run when something happens for no reason. And then, I mean, there must be programs that measure whether the book is empty behind what's happened.
Mm,
And if there's supply coming down behind what's happened, then they know that they can continue to push.
got
And,
it.
right? As
Yeah.
well as the whole concept of intraday retracements are no longer valid because you've already exhausted all the resting orders inside that range.
Bingo. Thank
Which
you.
is to your point of your barbell distributions that you were talking about with single prints in the middle. And Stephen was the one who told me about this years ago. He goes that the only place that you can find existing orders are above or below the highs or the lows, which is what leads to these barbell distributions. And then, of course, we need to know where the stops are.
Yeah.
So we're going to go try, and the markets are trying to find those stops as well. So there's many different aspects to the questions in regards to the ranges and the behaviors associated with that.
Thank you. Thank you. That just, I just, a lot of people I ask, a lot of people I ask that question and they really can't answer it. So it's really nice to to get your perspective on that. Thank you so
Stephen
much.
Stephen might have completely different views on that.
I mean, I'm pretty much in line with what you said. I mean, I think for sure the algos, as you made reference to, that's certainly an impact that wasn't there. I mean, the liquidity that was on the floor, and as far as on the screen now, I mean, as you said, there is not a great incentive to fade the order flow. So I think as you said, they're stepping away from it. I think all the social media out there today, I mean, markets are much more one-dimensional. I think that everyone has, what's the fear and greed and all these different, things that people look at. I mean, seems like everyone's all in or they're all out. I mean, as far as whatever it might be, the crypto space or the metals or the equities, you want to be long or you want to be short. It's, it wasn't so much a two-sided trade. It's more one-sided. And I think, Chris and I are looking at the software we work with, you could see this, the one-sided trade go two different directions within a day, and that would kind of, if you're looking at the standard profile, would kind of display something that's more, maybe a bit more symmetrical. But if you segment data, you can see there's an auction that goes one way first part of the day and then goes a different direction another part of the day. And for me, I think Chris is probably about the same time. You get the open, and I think statistically you'd probably see that Chris, tell me if I'm wrong, but you probably at least 2/3 of the days you're going to set an extreme in the first half hour, and then come 2 o'clock Chicago time or 3 o'clock New York time, it seems like another auction starts, and so you could almost trade two separate. I don't want to call them two separate days, but just two separate segments, and that's how I would approach it if I was going to be looking at the equity space.
Well, that's an interesting concept. In other words, there are people who are playing for the close. It seems as though with all the index funds being P&L to the close, it's where you get filled if you're trading an index fund.
Mm-hmm.
That's a very important number for a lot of people because billions trade at that number, and certainly
there's funds out there, right? That I mean, they just track what the mutual fund flows are going to be, and they know it's going to be net long buying or net buying, and so they're going to front run it, right, going into
Yep.
the
And then
last half hour
right.
trade or whatever.
So yeah, I guess you can judge like if they start at 2:30, are they going too early? And if they right, I guess that the accepted time now is if they start at a little bit after 3 o'clock, they can run it to the close.
Yeah.
And then everyone gets paired off at the close, and people who front run it are thank you very much. And the retail customer who's using index funds has no idea.
Yeah, let's try it again tomorrow, right?
Yeah. And their time frame is much longer.
Yep.
True.
Yeah, interesting. So you guys are veterans to the game, and you know, Chris, you even mentioned before we started the podcast that you think experience may even be a hindrance, which I'll let you speak to here in a second. Some I thought, and I've asked other guests this before. You know, we spoke about being an athlete as well, where you know athletes, they have their peak years, and you know it's mainly due to physical limitations. We don't have physical limitations as traders. Do you guys feel that you're the best trader that you've been today, or do you think you've had peak years? You know, I guess just speak to that.
People,
yeah.
Go ahead, Stephen.
I mean, for me, I mean, I would say the experience you gain over time, you know, that's gonna trump anything you have as far as being young and being reactive, because you're never going to be as fast as a computer. And you know, here in Chicago, we got Citadel and the money they're spending on access to markets and speed of trade execution. I mean, the only advantage you have is being young. I mean, as far as trading per se would be the execution of a trade, and that's no edge versus the big boys out there. You know, as far as being open to looking at new approaches, that's probably true. But the experience you gain through your 10, 15, 20 years of trading, I would say that more than offsets anything out there that you or me or anyone can find on the internet. I mean, Chris can, we've been around the block. We've seen a lot of people try to sell software or strategies or approaches, and not to, from my point of view, I really haven't seen too much out there that's too great. So, you know, a young person is going to be wanting to learn and spending more time reading and researching. But, you know, I think the time is better spent on finding some approach that resonates with you, and becoming proficient in that, and gaining experience. And that's going to be the experience that's going to really carry you as you get older, and can really offset anything anyone else can offer to you versus execution and things you can do at a young age.
Yeah, that's super well said. Super well said. I would say that experience comes with a cost. And certainly the markets are evolving. So you make a mistake. Okay, so you're going to dust yourself off, start over again. You're not going to make that mistake again. But will the market actually ever revert back to that same scenario where you had made that mistake? Probably not.
Right.
So, but what Stephen's point brought up an interesting thought, which was that, and someone on the exchange told me this years ago. They said, if you're, in regards to losses and then the ability to come back from losses, building a positive track record of slow positive cash flow, and the metaphor they used was that if you walk into a bank as a new business and ask for a loan because you've had a tough run of it, they're going to say, well, your business has no track record. There's no way we're going to loan you money. But if you come there after 5 years of being in business and you say, look, I've had a bad month or something, can you loan me money? And the bank looks at your track record and says, well, yes, of course, right? You've been in business all this time. This is just a temporary setback. And the concept that they were trying to enlighten me with was the understanding that from a personal perspective, if you go for slow positive cash flow, you can weather the occasional downturn, knowing that inside you have the ability to come back because of your track record of a slow positive cash flow. And so maybe history, to your point of history or of experience, maybe experience does afford you that if you can generate slow positive cash flow, if you're not a gunslinger, if you have a method, if you have as discipline and you have the curiosity to evolve with the markets because they're changing, then that would perhaps be a benefit of experience. There is also that sort of spidey sense of when things aren't working, and you're like, whoa, this doesn't smell right.
Yeah.
and so, or there is also the joy in watching yourself progress. And there's no one to pat you on the back, because these are hard-fought battles that you are having with yourself to get better. And you're like, okay, that is one thing where maybe experience can be viewed in a positive light.
Yeah, we have a saying, right? You're only as good as your last trade. You've heard that expression 100 times, and I think a young guy would take that to heart more than an old seasoned guy like me and Chris. We know that's not the case. We're going to look at a sample size of 100 trades, so we're not going to have the emotional roller coaster, but a young guy would look at things different. And I would say that's important to keep that in context. I think you have to pay your tuition, right? You have to, it's not, you're a good, Pete would always say it takes 10 years to say you can be successful in this business, because you have to go through all the economic cycles, all the psychological things that you have to deal with in trading. And, until you've done that, been around for 10 years, I mean, there's lots of people, Chris has seen them on the floor. I have, you get a drought market in the grains, and everyone makes lots of money and they give it all back the next 10 years. And is it more a function of your skill or being in the right place at the right time? And I think that's a lot of anyone, especially, young guys getting into the trade, they make some money and they think they're God's gift to trading, and it's not the reality at all. It's just a function of being at the right place at the right time. And I would bet 95% of those people give it all back, and then they realize it's more difficult than what they thought it was, and they really have to hunker down and put forth the effort if they do want to be successful.
Taleb writes about that in Fooled by Randomness for anybody who's interested in going into that theory a little bit more. It's an excellent book.
Yeah. Yep. And this is why I was grateful. I guess we were talking about like poker and like transitioning or gamblers making good traders. I guess like the equivalent is, someone who's getting dealt the deck in poker, right? Like he thinks he's great, but he's really just, he's just getting dealt the deck. He's getting great hands, and that's what keeps him coming back to the tables. And I would tell people, you don't get upset at that guy. That's what makes this game good. He thinks he's good. He comes back. But that great book, Chris, by the way. Yeah. Definitely encourage any listeners, go read it. And, that's what poker really ingrained in me is, the probabilities, the randomness. And yeah, just suggest everyone go out there, read the book. Chris, I wanted to ask you too. You have a Twitter, correct, Chris? I wanted to make sure I look up the right one.
Yeah, I'm Chris C. Cady.
Okay.
Chris C. Cady, because there were already other Chris Cadys, and my middle initial is C, so I'm Chris C. Cady.
So going through, I wanted to make sure that was your actual Twitter, because before doing the podcast, I wanted to just like look through, see if I could find any good tidbits, and you had some tweets that I found interesting. I just want to ask you about real quick.
Sure.
And then we'll wrap this podcast up. And if you had a tweet about something, I guess Steidlmayer told you. And he said always do the hard trade. What is meant by this?
Steven?
Oh, you put the quote out there, Chris. You can respond. You got it.
A hard trade is in the case of for example, the markets move from balance to imbalance, okay? And so just by the nature of just-in-time inventory, right? This is not some black box, magic theory. Pete used to say very quickly, he'd say if you ran a lumber yard prior to the internet, if the price of lumber got cheap, you'd load up on lumber. And as the price got expensive, you'd let the yard run light. Okay, then the just-in-time inventory comes along with the internet, and they're like, we don't have it, we can get it for you tomorrow. Okay, and then we got Amazon because of that, right? And retail stores went away. Pete's example was some guy comes into the lumber yard and says, I need to build a condo complex. The lumber guy says, great. Picks up the phone, calls the lumber pit, says, buy me a trainload of lumber. Lumber spikes up, right? And then he puts the phone down, gives the guy the fill of the price, puts on 10%. Everyone's happy. Contractor's got his lumber. The lumber guy's made 10%. And the pit's gotten new business. The idea of do the hard trade is that the market, if you're in the pit, and the guy, all of a sudden, the lumber guy comes in and says, what's here? And he starts lifting lumber. What you would have to do was actually buy in front of the guy about to buy a trainload of lumber. And that's wicked hard, because you don't know how big the order is, but you know that the market's leaving a position of balance. Right. And so by nature, if the market's leaving a position of balance, then there's zero chance of a retracement from a position of balance. And so you have to do the hard trade, which is like the market's been sitting there, and all of a sudden now you're paying high prices to get long. But what's happening in the next 10 seconds is that the prices will go higher, because everybody's trying to get on board this inventory displacement. So doing the hard trade is an emotional or a psychological process where you're actually trying to adjust to the market going. You're trying to be in step with a market that's going from balance to imbalance.
Yeah, you're kind of seeing a shift in value in something potentially, and everyone's kind of still stuck in what was the old value, and now this is a new value. So you have to kind of initially, the initial response is to fade all that, right? Initially, and then you realize that that's not the right approach, and you have to kind of change your ways. But the person who can pick up on that quickly, he's in a favorable position. But it's as Chris said, it's the hardest trade to do.
Yeah. That, you know, we've talked to a lot of people, a lot of great traders, and what I thought about it too, and I think it's true for myself sometimes. Like sometimes the best trades are like the uncomfortable ones, the one where it fits my requirements, my system, but I'm like, God, I don't want to press the button. I don't want to, you know.
Right. Every day is like this.
Yeah.
Every day.
Like the crypto is a perfect example, right? I mean, going from 15,000
to 30, right? Or the most recent move.
Everyone wants the easy trade is, it's a strong market. I'm going to buy it at 55. I'm going to buy it at 50. I'm buying it at 45. I'm going to buy it at 30, and all the way down. And then it's people selling it at 15. It's going to go to 12, and then it's the bottom's 12, and I mean, so it's also kind of a sentiment thing. What is the consensus? Kind of going against the consensus, which is it's hard to go against the consensus. It's easy to kind of load. It's easy to do what everyone else does.
You know, the guys in the crude pit say it's not crude trading if it's comfortable.
I like that. Another one of your tweets, Chris. And I haven't heard. I guess this was referring to you posted. I think it was like a picture of Gartman's not so simple rules of trading. And one of the rules I thought was interesting. It said, "Think like a fundamentalist, trade like a technician."
That you'd have to ask Gartman. I just posted that because
okay.
Okay. You know, having been just collecting things and then you want to, on the floor, people would always pass around newsletters, or we would get them sent to us, and I have an archivist tendency where I would just save what I thought would be important things down the road. Like if you ever owned a bar where people could come after trading and you could paper the bathroom wall with all these old newsletters. It'd be fun like that, but that hasn't happened yet. But there are, Gartman had a large audience.
Yeah, it was good. Very, very thorough, good newsletter for sure.
Yeah, he quotes Speed in there, actually.
Yeah, I'm sure he did more than once, right?
Yeah. No, in the rules, Steve.
In the rules? Oh, okay.
In his rules, he says, do the hard trade is Pete's rule. And he misspells Pete's name.
Excellent. I guess one last thing here, and then we'll wrap it up. And once again, sorry, Steve, this one's directed at Chris again. Chris, so you've had 3 different mentors throughout your career, and I'm just a little curious, maybe the most impact, if you can like speak to like one thing, maybe the most impactful thing from each one of them. And for the listeners, they were Walter Frank,
Chairman New York Stock Exchange, and Junior, who died in 1995 at a very early age. Then Victor Sprandio, Trader Vic, and then Stephen and Peter here, who are my mentors. I would suggest for people who are looking for mentors to investigate their teacher first off, and do very thorough job of investigating your teacher before you take a teacher. Then once you decide that you want them as your teacher, then do whatever it is they say, and make sure you follow through, and then always try and honor your teachers in any way that is possible.
Excellent. So that's going to conclude today's episode of Confessions of a Market Maker. If you guys enjoyed this episode, can you please rate and review it for us? If you'd like to join a supportive and professional community of traders, you can join us at microefutures.com. Chris, Steve, guys, let the listeners know where they can find you or anything else you would like for them to know.
I'll do Steve first. Steve runs Capflow Software. It's great. He's not easy to get lessons from, but if you can get a trial or anything, I highly suggest it. He's not much on Twitter. He's mostly at Profile Trading, I think, right?
At profiletrading.com, right? Mm-hmm.
Right. And then his book, which is old, is still pretty relevant.
Very.
And I'm on Twitter at Chris C. Cady, and I will answer when I have time, anybody who writes.
Excellent, excellent. And I'm pretty sure I said Caddy at first. If I didn't be intro, I apologize, Chris.
Happens. Don't worry.
All right. So for Chris, Cady, for Stephen Hawkins, I'm Paulie Walnuts. He's the gorilla of House Street. Use stops though.